I'm Alicia with Seraph, and this is our second or third interview in a series of interviews with emerging managers and people in the VC space. So we have Earnest Sweat here with us, long-term friend of mine, but also relatively new to the fund management space, launching his own fund here and also even active Syndicate. And I think you're a great person just to talk about the environment and what you're seeing in terms of fundraising and deploying capital. To get started, I think let's go ahead and have you introduce yourself and talk about your journey into VC and what you got going on.
Yeah, thanks for having me. Long-term friend and also long-term fan of what you're doing. So my journey, I started out in the VC space almost 11 years ago. But prior to that, I started my career out in equity research. And I think that was a perfect time to be a perfect place to start my career because it really it gave me the foundation to assess investments during a very tough time. I started my career out in summer of 2007. So right off the bat at 22 being taught, hey, stuff can go wrong, markets are cyclical, and you're still going to be expected to find alpha for your customers. And so that really just set the tone for my career, but also gave me some pretty transferable skills that I still use today. One, being able to take both macro events and micro events. So whatever's going on with the company at a micro perspective. And then I covered real estate investment trust. So like literally covering the entire macro environment. So what's going on in different macro, geopolitical, macro events, how's that impacting real estate? Second thing, how to actually communicate whatever insights and thesis that you have. And being able to do that both in written language and verbally, and being able to communicate that thesis to different stakeholders. And then lastly, ultimately what investing is about, especially equity research, but then I've definitely felt this in venture, is finding the truth. What is the true value of this stock? What is the true value of this company? What do I think the projected value of this company will be? And so all those three things with some other stuff, but mostly those three things and being able to ask tough questions really propelled me for venture capital. So how I got there, did that for 4 years, equity research thing, then got the entrepreneurship bug, like so many, and wanted to solve a problem and wanted to solve it. Problem I was really fascinated was with how people navigate their networks. And I felt, and still to this day, I feel like LinkedIn is just a, I don't know, like just a Rolodex, digital Rolodex for us. And so I wanted to, yeah, exactly. And so I wanted to utilize early email. Also, the API firewall wasn't as strong for LinkedIn as it is now. And really provide those insights to people that they could cultivate a stronger network for their network and also tertiary networks. Raised about $100,000 and then made every first-time founder mistake you can think of. And so one, I took a horrible go-to-market motion where I wanted to go after younger professionals. So colleges and cities I was trying to sell through, which are really hard. And then if you're going to take a hard path to sell through, you need to have advisors who can help you skip steps. And I didn't equip myself and surround myself with people like that. So as we sunset, I went to business school because I was still fascinated with biz market. Went to Kellogg and focused on entrepreneurship and finance. And that's where I discovered venture. I had every plans of just working for a startup as their first business hire. But this program at Kellogg you could work at an international venture capital firm. And I got placed in New Delhi, India. So I went there for the summer, which was awesome. And worked for an ed tech and future of work venture fund. And I was hooked from that point on. So that's what kind of laid the foundation. Then moved out to the Bay Area. Been out here since 2013, been in venture since 2015, and have worked at places like Prologis, starting their first corporate venture group, have built out traditional firms, their enterprise group, Great Point Ventures. And now I'm on a journey to build my own firm, Stresswood, which will be a Series A lead only firm, generalist firm. So,
Right. Amazing. Thank you for that. And that's you skipped over the syndicate, and I want to talk about that a little bit too.
oh,
Yeah. So you have really deep experience in like from start to finish in terms of early stage investing. And so what was your thought originally with the syndicate rather than like just launching Stresswood? Were you like,
yeah.
did you back your way into the syndicate on accident or like,
No,
tell me more about
that's
that.
I'm glad I left it out because then it could open up that great question and then we can get into it. So I try to do things just intentional because I like to take really big swings. And so it's not waiting for the perfect time. It's just like being self-aware of like, all right, how do I best position myself to really succeed? And so when I left my previous firm in the summer of 2023, I've always been targeting Q1 of 2027 to launch a fundraise. And so the way it works for in my head is like, all right, if that's the target, how do I work my way back? What do I need to accomplish? And my first couple of things I was doing were just almost like they're experiments that I think I need to do, and then I can refine them to best position myself for raising a fund. And so one was investing, and it was like, I want to keep investing. There was always this paradigm, you got to stay in the flow. You got to keep investing, even though I've had, at this point when I'm leaving, I've had 9 years of experience in ventures. Ultimately, I found I was like, I don't actually need to keep investing just to keep investing. I need to be investing with intention. And so I first started a syndicate, which I'm still doing, Public School Ventures, brings together about 800 angels and operators and small family offices. And they invest alongside me in Series A companies that are usually B2B in the areas that I know well. And so my thinking was, oh, I need to stay in the flow. Can I show people and prove to myself that I can raise, even if it's a small ticket, and get access to companies? And yeah, was able in 2023 and 2024 to easily prove that. And so the thinking behind that, it was like, it was one component. I need to prove that I can still write checks. And I've even iterated on that, which we can get in on later. But the initial was like, I need to prove I can still write checks. I need to get access to my two most important customers as a venture capitalist, which are founders and LPs. And then I also need to advise as many stakeholders in the ecosystem. One, to develop that trust, but then also to make, a lot of people don't talk about the runway you need just personally to be able to like raise a fund. And so that was the mentality and why I started the syndicate.
Are you going to continue the syndicate even after you've launched the fund? So say you guys hit first close on the fund, are you going to continue with the syndicate for sidecars?
So that's a great question. I doubt I would keep it going. And just to tell you how it's grown now. So it started out at 100K, 200K checks into companies that I would raise. Now we've matured thanks to some relationships we've been able to get. And now we're at 5 to 10 million. And the reason why that big kind of jump, and it's less checks also, is because as a fund manager, one question I'll get when I'm fundraising is going to be, hey, can you get back to your normal check size? And you're like, well, I've always been doing that. But they're like, recently you've been doing these smaller checks. So to prove that I can do that is one. The other thing is it just shows signal that it's one thing for a founder to let you into a company for 200K. It's another thing when they let you in for $7 million, right? They've knocked other people out. And that shows that you can really move weight. So that's been the evolution. What to do with public school? I've actually been thinking about every entity and experiment that I've been creating on this path. Is there a way for me to give this to someone who's further behind me, younger than me, who's going on this journey, who has experience, but is looking for vehicles in which to continue their journey as a fund manager. So I've been thinking about that, but I don't know if that'll crystallize or not.
Yeah. I think what it's worth, I think that would be like, given you have something that's up and running and active, and I know you're probably going to look at a lot of those LPs to be LPs in the fund, but it's always worth exploring because there's people that need to get to the next step. And like, it's given you have it up and running to shut it down, you know, it for then somebody else is going to have to start it up anyway. Like if you've already got it and you can tangentially be involved, it could be an interesting thing to pass along to someone else or a group of someone else's. Like I know, were you in maybe you're in Kaufman Fellows?
Yeah,
Or
Kaufman,
so there's
a lot of organizations, Kaufman, Black VC, other organizations that are training and equipping the next generation of investors, which if we don't, I'm more than likely going to do something like that. And I've been even thinking about, as I get busier, is there a way for my podcast, which is called Swimming with Allocators, if folks want to check it out. But we interview LPs of all sizes who are interested in venture and growth equity. And that would be a great opportunity for somebody as well to have. Now, I plan to always be involved and continue to interview no matter if I'm on Fund 4 or Fund 5, but giving that opportunity to other people to get that access will be vital.
Yeah, cool. So let's move on a little bit to your new fund. Maybe can you give me some background on why Series A? So I know you guys are raising a huge fund. And as far as before we talked about this the previous time that we chatted, it made less sense. Now it makes more sense given you're deploying such big checks. Like when you say your syndicate is doing $5 to $10 million checks, like that's a whole first fund for someone. Exactly. Right? Like, that's a whole emerging manager fund at that point. So that you're doing that and now leading into a bigger fund for Stresswood makes a little more sense. But I think in terms of the audience here, give me some background on why the size, why the Series A focus, and what you're hoping to do with it.
Yeah. So the main reason is just me being self-aware. It has nothing to do with a grab. Just to tie the knot on that, I do think too many people just chase like growing and their scope creeps as fund managers because they can raise, and not that they're the best investors at that fund size, but they getting more A means more fees. But I never envisioned Stresswood being anything more than, if our first target is 275 million, then I don't think Fund 5 should be more than 400, 350, like always staying in that range and being that early growth investor as Series A prime. Now, why Series A? Because that's being self-aware and looking at my entire venture career. That's where I'm the best investor. Like when I've made seed investments, I've been pretty good, but most of my seed investments get bought early, which is not why we invest in venture, right? Yeah. But when I'm able to see a company that has some early traction and able to also invoke my superpower, which is being a very intentional super broker and connector, that's where I shine. And I've been able to compete with some of the best firms at high quality companies and founders because of that ability of mine to assess what their ideal customer profile is that they're going after, and finding people during the diligence process that fit that mold and showing them in day zero that, hey, this is what you get when I'm a part of the cap table. I'm able to bring you individuals that could cut your sales cycle in half. It's all because of what I like investing in. And I also think, so that's from a micro level. A macro level is, I think that a couple of things are going on. One, from afar, the competition at Series A looks fierce. But if you actually dig in a little bit, that there are a lot of people investing in Series A, but not many people focused on Series A and Series B. So you have the traditional kind of blue chip firms who started out at Series A and Series B, and now they're doing multi-stage. So they're focusing on, some firms are focusing on everything from inception and competing with YC to all the way to public markets. And so can they, yeah, they'll see everything, but are they the right partner? That's my question. And then the other group is growing is your kind of blue chip seed funds that have grown to 400, 300, $500 million funds. And so they're scoping and creeping up to Series A investing. But again, where they made their mark was in pre-seed and seed. Are they the best Series A investors? And so this is a question for founders, right? Who would be the best partner for you at such a critical moment? Who could be a great not just signal for you, but they actually help you determine between noises in signal and finding revenue. And so I believe I'm a key piece to that. But then I also believe that another thing that's going on is we have an elder millennial cohort. So, 35 to 45 that has experience in venture that's being underutilized. So there's an opportunity to bring basically the Avengers together and different teams. And so if you look at the history of venture, great firms today have been built from tier 2 and tier 1 firms, younger, middle-aged GPs coming together and creating something new. And so that's what I want to do with Stresswood.
That's really interesting. And you pointing out the creep of, I think a lot of funds as they continue to grow, either they're creeping forward or backwards. A lot of the ones that come in at Series A or Series B will, at least I think, start to creep backwards because they recognize they want earlier and earlier access. But to your point, that's not necessarily, that's good for them. That's not necessarily good for the founder. That's not necessarily, it could be helpful from the standpoint of like you have a built-in investor at every stage. So if they've invested at seed and then they also have a Series A type fund and a Series B type fund to make follow-on investments, I could see how that would be helpful. But in terms of the milestones and like the metrics that they're trying to hit,
they don't?
Yeah, but what if they don't? I don't know.
But no, I'm saying, what if they do have it, but then they don't invest in you for the next fund? Like the signal, like issues or noise issues, or somebody, this is my claim has always been both those sides, whether it's growing seed funds or multi-stage funds, are doing call options on people's life work. So it's just, yeah, maybe we'll do this. So we get in early and then maybe if it hits, we'll do the next round. Whereas if Stresswood, we will be focused on Series A and A prime. This is what we do. So we can help you get to that next round, help you get those blue chip investors for the next round and scale. Or if there's another strategy to help you scale, because venture's changing too, right? Mm-hmm. Will companies need as much capital? So I think it's a point where over this time, we're really trying to challenge every paradigm that's worked in the industry that personally has worked for us as well. And being a team that is really able to help founders and founding teams be the best teams that they can be and reach their like highest potential.
Do you feel that a lot of your VC counterparts, do you feel that they meet their promise to help startups?
No.
Okay.
Just like straight up no.
It's one of those post-investment value that we provide. I think that it's something that VCs do. They say a lot. The angel groups say that to a certain extent too. And I don't know how much, like a lot of times founders seem like, yeah, they're just happy to get the dollars, which is great because I get you off the ground and get you from zero to like something. But then
it does.
The human capital part of that is not, seems to be like overpromised, possibly underdelivered.
Oh, not possibly. Most of the time underdelivered. I personally think there's only kind of a few ways venture can really help companies, and that's commercially. And so, can you help connect people to get them dollars or revenue or skip steps? That's literally it. Maybe some insights, but your founding team's going to know more about an industry and nuance. They should anyway, than you are. And so, yeah, I've always thought it's going to be revenue that really helps your companies. Yeah.
The question, like, can you help me skip steps, is, I think, a really great way to put it. I'm going to make a LinkedIn post about that. So thank you for that. That's really helpful. So let's maybe talk a little bit about your fundraising journey. Like, what have you seen? So you've been doing public school ventures for a while, syndicating deals, and now you're raising the fund formally. What, or you're going to, at least coming up soon. What are you guys seeing from like a fundraising environment? The general mood is tough, is what I'm hearing, but it's always tough to a certain extent.
So we're not starting fundraising until Q1 of 2027, and we have time, and we're actually not trying to time the market as well. We're trying to make sure we have our ducks in a row and who's all going to be on the team, and also developing those relationships before we have to. That was one lesson I got at my previous firm, is I brought in a lot of institutional relationships, but saw that most of them were like, hey, we're not going to do anything soon with you. Like, asking for money when you initially meet somebody or expecting it from an institutional LP is like going on a first date and popping the question. It's weird. And so being able to have that time to develop those relationships, and I've been talking to so many LPs now through this podcast, they also just want to see if you're going to do what you say you're going to do. So many people say, and they want to do this, it gets hard, and then they join another firm, or they get another job, or they just quit on it, or completely change their strategy. And so you have to have the time and conviction to be able to do it, and actually just know what your voice is too. I think the environment right now is tough. There hasn't been much liquidity. Not much is going to emerging managers. We have way too many spin out funds that have come out because a few have successfully fundraised. And so now everybody thinks if we mix and match this blue chip fund with this blue chip operator, then we'll raise a lot. And it doesn't come out like that all the time. And LPs really want to see what's going to be differentiated and what is their book of business going to look like. They're assessing right now too. Okay, everybody's coming up for re-ups. Who can we actually do? And so a lot of them are going to go back to who's made the money already. And those who haven't, it's going to be tough. And other things that they're thinking about are like, who's providing venture beta and who has potential to provide venture alpha. So yeah.
Your LP base, both the ones that you're interviewing and the people that you just know either via the syndicate or otherwise, can you give me an idea of who those people are? Is it like family offices? Is it institutional type investors, the fund to fund investors? Are they just like individual high net worth people that like are investing in venture now as a part of their portfolio strategy? Or like, what does that base of folks look like?
Yes. The goal is to have an institutional fund where we'll have family offices, but the size of our fund, in the aspirations to being a franchise and not just like a one-time thing, having institutional capital would be essential. And
when you, just to add clarity there for people, when you say institutional, are you talking, I don't know, like Kellogg's, endowment fund type institutional?
Yeah, anything that is not a family or multiple families. So anything like
Okay.
more institutionalized than that. So small fund of funds, all the way up to sovereign wealth funds and everything in between.
Okay.
So that includes endowments, that includes pension funds, that includes insurance companies, that includes foundations, all that stuff.
That's really interesting.
So we've had on the podcast every type, whether it's like outsourced CIO, family office, fund of funds, pension funds. We'll have some endowments on soon. We've had some foundations on. We try to have the gamut and of it, and we're really looking to ideally, and if I'm going for the long haul of if it takes 2 years, it takes 2 years to fundraise, but I hope it doesn't, but if it does, but I think what all fund managers aspire to have is their choice. Not many get this, but they aspire to have their choice of LPs. And you meet so many cool individuals who are thinking innovatively, who represent foundations and folks who look like your parents in their pensions and stuff like that. And you're like, this is who I would love to invest with, to make profits for, are these organizations or these universities. And not many people, if you don't have a thought out strategy, if you could have a thought out strategy and it's the wrong time in the market, you don't have enough personal runway, whatever it is. Sometimes you don't get to plan as well to actually meet that goal of being able to be choosy on who your LPs are.
Yeah. Okay. So the personal runway thing is something I want to double tap on there too, because both from anyone fundraising. So you could be like a startup or you could be a fund or a syndicate lead, like anyone fundraising. I think it's undercounted how much time and effort it takes to raise a round of funding. And I think we've done a couple of interviews and webinars related to this recently, and 2 years, like 24 months seem to be about the allocation that you need to give it. And so make sure you can sustain yourself and your life and your family for that amount of time. And then you might get there.
Yeah.
It takes a long time. And I think people entering, or like people, especially startups that are raising their first round, like your pre-seed round, without their relationships in place, it takes one tap, right, to meet them and have them tell you no, or let's have a conversation or something. And then more than likely it's a no. And then you come back in 6 to 9 months. And that whole cycle needs to happen in terms of touch points and building trust and them seeing your name like 5 different times. It's a very long, labor heavy process, in my opinion.
Yeah.
And I think that's something that people don't necessarily understand from the outside, because they see the fund launch, right? Like they'll see when you guys hit first close, there's going to be an announcement, everything's going to be happy. But like all of the work that you're doing now in 2025 led up to that first close in 2027 or 28.
Yeah, it's a I was recording a podcast yesterday episode, and a guy who used to he was the CIO of the Robert Wood Johnson Foundation. He was talking about, the process of the overnight sensation that took 20 years. Like, it's just like people don't realize all these things, all these conversations, all these like touch points. You have to do all this work to be able to actually have that launch email or launch article to actually happen. And it's one reason, and I'm challenging some paradigms, because a lot of times I've had friends that be like, wow, man, that's a really long way out. Like, why are you, and the assumption is like, are you scared? And it's no, I'm self-aware and know, who I am, what I'm swinging after. When I tell them like the fund size, I'm like, oh, it's like, I've always been a Series A investor. what kind of fun size did you think I was going to do? I suck at
Everyone
C.
tailors down to.
And then the other person part is, I don't know if you know this, but I'm not financially like rich. If I was already, I would have started. First of all, I wouldn't have probably worked at any of these funds if I was already rich. I would have just started my own thing a long time ago at 30. But to give me the best shot, I need to work my butt off, build a trust in my own way. And so I'm challenging that of even like telling people it's 2027, or I'll be launching a Substack that like literally puts in all of my different things, my newsletter, my different podcasts that I'm working on. Something like this interview, all of it to show there, and it's called the groundwork. So like to be able to show all the groundwork you have to do to actually build something.
That is really important. That is really important, especially for people who are trying to be intentional about the next steps that they're taking. Taylor and I like constantly come back to this because it's not what we're doing now. It's like what we're doing now that influences what we're trying to do in 3 or 4 years from now.
Yes.
And all of the little relationships and all of the every single email that you're sending, but whether that person knows you or is willing to work with you later because of it, it's all like way more important and stressful than I think a lot of people think it is. But
I think a lot of people also give up. Like it's really tough. And I've actually been, whether they've been short-sighted or what, I've worked at some places where people didn't understand the groundwork of like, why are you reaching out to so many people? Or is it more efficient? And it's, hey, I'm trying to manufacture luck too. And what's the research on? It's like loose ties provide more breakthroughs than like your initial network, because it's more your initial networks and have more people who think just exactly like you or have the same access points as you. It's those people right out that then like magic can happen. And so I'm trying to like manufacture that magic all the time.
yeah, and honestly, I think you'll get there. This will go out to 12,000 plus people, and
Uh,
somebody will see it that'll
yeah,
be
yeah,
interested. So yeah, I think that's as a strategy something that more people should think through.
yeah.
Um,
The other thing is people have to, and this is any industry, any function. If you're mid-career, let's say you're 30 to 45, if you're not leveraging the tools that are out here now, like you're doing yourself a disservice. All the vibe coding, AI, automation opportunities literally can help you 2x your productivity. And more importantly, everything that you do that's manual, that maybe is a means to an end. If your superpower like mine is to actually connect with people, that then I can understand what their needs are and how I can help and do my connecting thing, then it helps, because it helps me get to like, all right, now I can have that meeting and that phone call with this person or that person at a faster rate than spending 10 minutes wordsmithing an email.
yeah, I think that's really important actually, especially people who are doing white collar work, like us building PowerPoint slides. There's a company I saw called Gamma that I tested recently, Gamma
Yeah.
AI, that builds. I was like, and I knew it was possible in theory, but to see it done, to just build a whole presentation off of a paragraph that I wrote, the
Yeah.
system is like
Yeah.
wild, because that would have otherwise taken me an hour to do. And
Yeah. Yeah. It's getting crazy out there, and it's going to get
mm-hmm.
smarter and smarter. So everybody should use that.
Yeah, no, I agree. So we're coming close to time. Maybe one other question about swimming with alligators. So your
Yeah.
podcast, how long have you guys been running this? A year and a half or so? A little longer?
Yeah. So November of 2023.
Okay, cool. Yeah, no, tell us a little bit more about what the intent is for the podcast and some of the things that you're like learning, any important insights that you guys have drawn from those interviews. Because I know you're like interviewing a
Yeah.
lot of people, a lot of high level
Yeah.
folks who are investing, very active. So any insights that you would like to share, I think would be really cool.
Yeah. Anybody who wants to be a fund manager or an allocator should listen or watch. We're on YouTube as well. But the intention was me and my co-host Alexa were both leaving our firms, and Alexa was thinking of maybe like advice on helping with her small family office. And I was thinking about, all right, what do I do next? I love venture. What should I do? Should I join a fund? Should I start something? And we both were having conversations with LPs separately. And I was just like, man, I wish we could like share these conversations I'm having with us so other people could listen. And, we noodled on it for a while. And then eventually we started seeing other people have focused LP podcasts, but they weren't exactly like what we wanted, because we wanted something that was neutral. We weren't selling ourselves as an allocator. We weren't selling ourselves as our fund managers. We were just like asking questions. And so honestly, the thing that I'm really moved by names. And so she came up with the name and I was like, we got to do it. I don't really care if we're successful or not. Like, we got to do it now. And things that like the intention was, we wanted to, I'll be 100. I was like, I wanted something that could be an easy way for me to meet a lot of LPs and learn from like how they're thinking. Indirectly, what's happened also is I've learned that I've had a history of building community around content. And first I did it with when I was first breaking into venture in 2014, 2015, I wrote this blog on Medium called The Importance of Reading Earnest. And I still have people who like are a half generation or a generation behind me who like said, hey man, that was helpful. And what you're writing, your investment thesis for interviews has been helpful. So as this has been developing with Swimming with Allocators, I'm like, oh, wow, this is happening again, but it's happening for upstream investors. So angels, pre-seed fund managers, seed fund managers are like, Earnest, this is where we're required listening. Thank you for making this. Made our first meeting with XLP much better because we listened to it. And so that's really been awesome. And then allocators who want to be or don't want to be on the show have conversations with me because they're like, hey, you've been hearing from all these allocators. What have you seen? What are the synthesis of information? And so the main things I've gotten from it are every LP is different. And no matter if they're in the same kind of subcategory of endowment, pension fund, or family office, or fund of fund, people have different strategies and different things they're looking for. Two is it's a relationship business, and people forget that, right? Just because they don't invest in fund ones doesn't mean they won't invest in you forever. And just because they don't invest in you doesn't mean that they don't want to invest in you or that they can't lead you to someone else who will invest in you. So many factors come into an LP investing in you that have to like align, right? They have to have extra capital. They have to be interested in emerging managers. They have to not be overweight already in what you do. And so there's so many different factors. So don't make it so transactional. It's if you meet someone and they don't want to be your friend immediately, is that like yeah, so many things have to align at times, but people are looking for a friend and all this stuff. Like you have to have the same interests. You should apply those same like principles to developing relationships with LPs. And then the last piece I'll say is that it's all vibes, to be quite honest. Like, honestly, I'm starting to realize that at 40, everything is vibes. Economies are vibes. Like everything we try to put like real hard numbers with is just like humans don't make decisions practically.
Yeah.
Most of the time they don't. It's mostly emotional.
Feel something.
It's mostly emotional. And so when we try to say, oh, it's just about track record, no, it's just like getting into college is not just about your GPA or your SAT scores. It's not. It's vibes, the whole person.
Yeah.
And so leaning in and being self-aware of what you don't have, but also not focusing so much on those gaps where you underweight the things you're really strong at. And so this whole process, even preparation, it just made me lean into, okay, what are my 4 superpowers? What am I always good at? What's the story and through line that founders, LPs, people who work with me will always say? So yeah, those are the main things that I've learned. And then for me personally, I've learned that like I'm really amazing at asking questions and developing like rapport with people.
Okay. Cool. So close out here, maybe one final question. Do you have any advice? I know there's a lot of this interview that could be taken as advice anyway, but is there anything else that you want to touch on? Do you have any advice for people looking to either break into venture or make their next step into something different within the venture realm? So anything you want to leave people with on that front?
Yeah, I think showing an interest by also showing what you can bring on day 0 is very important. Every job I've gotten in venture or even now with the consultant, like I've created and was doing work before I had to do work. And so that's not always doing free work, but it's like being able to show how you're active in the ecosystem, what you add in value, and what's your unique perspective that you're able to bring.
Yeah, that aligns very closely with what all my general career advice is. If I talk to a University of Wisconsin, there's an entrepreneurship program that I go back to speak to once in a while. And that's always my thing is prove your value before they're paying you dollars, because that's what matters. Like you have to add value before someone's formally contracted with you to do.
Exactly.
And it takes effort and time.
It does.
Like that's a cost.
Even if it's just insights when you're talking to them, that because you already know it. Because there is a flip of like, when I was younger, I actually was doing a lot of, oh, here's the like preparation and work. But now since I have that baseline, it's just in my memory and I can just share it. Because there is a point when you get to like that, I'll say probably 35, 34 range, you don't need to be doing nothing for free. Like, it's just like, I'll do a call with you, show you how smart I am in insights, but again, you're not getting nothing else out of this.
Yeah.
Yeah.
Okay. Well, thank you very much.